So when we look ahead to 2026, the picture that's emerging is defined by this massive and, frankly, dangerous contradiction. On one hand, you've got this euphoric optimism in the markets, but on the other, you have these incredibly powerful structural forces that are pushing the global economy right toward a cliff. Understanding this conflict is absolutely the key to navigating everything that's coming next.
So this is it. This is the central question every single investor has to answer right now. Are we going to get that soft landing the markets are so desperately hoping for, or are all these underlying risks finally going to drag us down into a recession? You know, the tension between these two outcomes, that's where the entire story of 2026 is going to be written. And look, this isn't some trivial risk we're talking about. Top-tier institutional analysis is putting the probability of a U.S. and a global recession in 2026 at 35%. Just let that sink in for a second. That's more than a 1 in 3 chance of a major economic downturn, and that's coming from the people who watch this stuff for a living.
And this is where things get really strange. You see this massive disconnect. I mean, how can the market possibly be forecasting double-digit gains while staring down a 35% recession risk? Well, the answer seems to be that investors are pricing in all the incredible upside of an AI productivity boom, while at the same time, they're critically underpricing the very real financial costs and economic risks that are lurking just under the surface.
So, how do we make sense of all this? Okay, we're going to break it all down. We'll start with this great market disconnect and why the old defensive plays are failing. Then, we're going to dive into the central bank standoff, this new inflation time bomb, and the really wide range of growth outcomes. And finally, we'll wrap it all up with a clear, actionable investment playbook for 2026.
All right, let's kick things off with a foundational problem here. The traditional safety nets, the ones investors have relied on for decades, well, they're starting to unravel, and that's leaving portfolios way more exposed than a lot of people realize.
And this quote from the Bank for International Settlements just nails it. In simple terms, what this means is that when the market gets scared, when the VIX, the fear index, spikes, U.S. Treasuries just aren't rallying like they used to. This breakdown of the ultimate safe haven asset is a huge deal. It forces investors to look for safety somewhere else, and it dramatically increases the risk in the entire system.
Okay, let's move on, because this problem, it's not happening in a vacuum. It's getting worse. We are now in an era of what you could call monetary fragmentation. The world's major central banks are no longer moving in unison, and this divergence is creating immense pressure on currencies and, of course, capital flows.
A perfect example of this is what the U.S. Federal Reserve just did. They delivered what we're calling a hawkish cut. Yeah, they lowered rates, but their internal forecast showed this extreme division. The bank signaled maybe just one more cut for the entire year. That signals deep uncertainty inside the Fed itself.
You can really see this divergence when you pull back and look at the whole global picture. The U.S. Fed is kind of hesitantly easing. The Bank of England is actively cutting to try and boost a weak economy. But the European Central Bank, they're holding firm, with no cuts priced in at all. These are 3 completely different paths.
But here's the real kicker: the standoff between the Fed and the ECB. The Fed's hesitant easing is in stark contrast to the ECB's rigid stance, and this policy differential is the main driver behind the institutional forecast for a weaker U.S. dollar and a stronger euro heading into 2026.
All right, let's shift gears and talk about the next major force at play, inflation. That whole debate about whether inflation was transitory. Well, it's over. We now have to focus on the permanent structural forces that are set to lock us into a higher-for-longer price environment.
And one of the biggest and frankly most overlooked drivers here is the hidden cost of the AI revolution. It's absolutely staggering demand for energy. Just take a look at this. Right now, data centers already consume nearly 5% of all electricity in the United States. That's already a massive slice of the pie from an industry that's really still in the early innings of a massive build-out.
And it's not stopping there. Not even close. Its energy needs are projected to more than double by 2030. Now, this isn't cyclical demand that ebbs and flows of the economy. No, this is a massive, inelastic, structural demand shock that is going to place persistent upward pressure on utility costs for absolutely everyone.
So when you start adding this all up, you take that exploding AI energy demand, you combine it with sticky shelter inflation, the higher costs of building resilient supply chains, and these geopolitical risk premiums, you get this powerful cocktail of structural price pressures. These forces are here to stay, and they're making the job of central banks almost impossible. So, what does all this mean for global growth? Well, it brings us to an outlook that's just characterized by an unusually high degree of uncertainty. Seriously, the range of possible outcomes has rarely been wider.
This chart right here just perfectly illustrates the confusion. You've got JP Morgan on one side highlighting a high recession risk, while Morgan Stanley is over here forecasting moderate global growth. This level of disagreement among the experts, well, that's a flashing warning sign of just extreme uncertainty.
When it comes to the U.S. economy, which, let's be honest, is the anchor for the whole world, it really boils down to two possible stories. The upside story is an AI-driven productivity surge that pushes GDP above 3%. The downside is a mild recession as the delayed effects of all that tighter policy finally take a bite. Which path we take will pretty much determine the fate of global growth.
Okay, that's the diagnosis. So what's the prescription? With that incredibly complex backdrop, let's move from analysis to action. Here is a clear, actionable playbook designed to find durable value right in the middle of all the chaos of 2026.
First things first, we have to look at where the market stands right now. Overall, the U.S. market is trading at a modest 3% discount to what we'd call fair value. But the devil is in the details. Look at the no-moat companies. These are the ones without a durable competitive advantage, like a strong brand or unique tech. They're actually trading at a premium.
But now, look at this number. This is the one that should really get your attention. The small cap segment is trading at a massive 15% discount to its fair value. In a market this fraught with risk and uncertainty, this represents the single greatest opportunity zone out there, offering both a margin of safety and significant upside. So the mission, the strategic mandate, it becomes crystal clear. In an environment with persistent structural inflation, the ability to pass costs on to your customers, pricing power, that is everything. That means aggressively selling those overpriced no-moat stocks and rotating that capital into quality companies with durable competitive advantages that can actually protect their margins.
So let's boil it all down. Here are the 3 non-negotiable moves for your 2026 portfolio. First, attack that 15% value gap in high-quality small caps where value is hiding in plain sight. Second, hardwire your portfolio with real assets that can actually weather inflation. And third, demand durable quality in every single stock you own, because only companies with true, lasting competitive advantages are going to thrive. And that really brings us to the final question you have to ask yourself. In a market that is so fundamentally divided between this euphoric hope and this deep underlying risk, where are you going to place your capital? Are you going to bet on broad market optimism, or are you going to focus on finding deep, durable value? The answer to that question will define your success in the turbulent year to come.
This video offers a guide to the 2026 economic outlook, organizing high-quality research from leading financial institutions into key thematic areas. We explore major topics shaping the 2026 global economy and investment landscape. Thank you for watching this video. You can further deepen your market expertise by reviewing the high-quality sources and in-depth research we used.